All right, so just announcing next Thursday, USA, we're having a USA Day. We set this up. I was going to do it. I was so excited. We're going to do it April of 2020. And for some reason, it got canceled right in the middle of COVID. So they're going to come in, they're going to talk really everything. So finance, accounting, they have something called state something, but it's product development, which is pretty interesting at USA. It tends to be property casualty focused. The cyber people will be here, actual science. We need to get the actuaries in. USA is a big hire of actuaries, especially on the property casualty side. They have several of our alums are there on the actuary and finance side. They love UTSA. USA is a great company. It's struggling right now, but it's not struggling because it's not a great company. It's struggling just it's growing so fast, and it's having some issues trying to figure out who they are. But they have some incredibly great people working there. Um, so what I'll offer you, hopefully y'all won't need it, but if if you show up and I'll make sure you're there, I'll give you one extra absentee by Zoom thing. So you get three, you can have four. All right. So if you're having a problem with absentee, but show up anyway, just make an appearance and talk to them. It's property casualty, life insurance, banking, real estate, although it's hard to know if their real estate company still belongs to them. A lot of decision science. The finance jobs they don't have the investment side anymore, so they outsource that. But it's a great industry to learn. It's a very collegial firm, a friendly place. So I loved it because you could essentially get up from your desk and go talk to anybody at any time, and they would talk to you. You could learn. So it's a great firm. So I encourage you if you don't know anything about them, they go to the meeting. They have jobs that they usually close those applications, but they just said they'll leave it open through this meeting. So you could go listen about the jobs, give your resumes, and then apply and see what you can get. It is a good company to go after. Any questions on that? Now, 5 o'clock, it's going to be the Insurance Council of Texas, which is property and casualty side. They're going to talk about careers there. So 4 o'clock to 5 is USA. They're going to do a big presentation, then they're going to break up into tables for each job type. So you might say, I want to do the financial planning area, which is how I got in just many years ago. But they also have other jobs that they hire finance people for that you can apply to as well. All right. So I want to not grade paper one. I got three papers, but I only have time to do a couple of them. But I just want to show you how I would do them. The papers I got were well written. They all had some issues just because we never get to perfection. So I don't remember whose this one is. So they start off, that's a little long for an abstract, but you can certainly do that. Just one thing I'm looking for, well, let me just show you the rubric that I use. There's some things on the rubric that are very obvious. Number of jobs added, 187,000. Do you have that number in there? I'm looking for that. Number of jobs expected. You got to have that in there. There are multiple of that. Be careful. Some people are putting the table in their paper and then they get an article with a different number. Don't say expected was 170 in the table and then use 160 and you're right. Make sure you're consistent. The prior number, you got to put that in there. You can talk about how much it was revised. Try to get those first three all in one sentence if you can. So the jobs came out at 187, well above expected at 170 and above the prior month's revised, whatever. You know, you can get it in one sentence. The only thing you got to add, usually you get full credit if you said that. The other thing you have to add is an adjective of some kind. Was it strong or weak? I saw one paper we used the word resilient. So it wasn't a particularly strong report, but given everybody's talking about recession and hard landing, it was a good enough number that the word resilient can certainly work. I don't know if I'd say extremely strong. It wasn't a particularly above average, below average. It was a fairly average month. But given everybody's worried about inflation and the Fed and all that, yeah, that's probably a pretty decent number. The private number is important. And then on the rate, here's a little tricky because the prior and the expected were the same, 3.5. If you put them all both in there, And then it came out at 3.8. So how do you handle that? So you're all probably going to say something really similar. It's surprise on the high side, but that doesn't tell the full story because of the participation rate. Okay. And make sure you talk about participation. Wages is important. Those numbers in there, they weren't all that particularly exciting this time, but people were watching them. And then find something else to put in there. There's a lot of choices. Just make sure you set it up. So your boss didn't ask for anything else. So those kind of things, you start off the paragraph with just to put some context to this number or show what else is going on. Since inflation is such a big number, maybe look at the last inflation number. I don't know when it was reported, and maybe it's reported August 20th. You can say the markets are definitely focused on inflation. The last CPI number came out at X%, August, whatever. You can bring those kind of things in there. ISM, here's why I'm picking on ISM. So one paper I got as an example was really well written, but they somewhat followed. I should take this one student example out because what they do is they talk the jobs report, then they talk the stock market, then they talk ISM. Where should ISM go? Before the stock market, right? So get all the economic stuff done first, and then start talking about the market reaction, all right? Because ISM, you talk about the stock market, and then you suddenly throw the ISM, and it's like, why are you talking about this? So why do you put the ISM last? You're saying, okay, there's the jobs report. Another report came out this week, the ISM. This is what it said, just to put some context, all right? It didn't come out that Friday. It came out on Wednesday. You don't have to talk about the stock market reaction to the ISM. You're focused on that Friday. That's the other thing. Be real careful. You're talking about Friday. You can't go beyond Friday. Right? You know all kinds of stuff that happened since Friday, but you're pretending like you're writing this paper on that Friday.
So the ISM for August, it came out Wednesday?
Right. It always comes out the Wednesday before. I don't know if it was for August. I guess it was, but yeah. The ISM to me is confusing because there's two groups that use very similar numbers and they can get confusing. The most important number in ISM is the new orders. So if you're trying to find one number in particular, the new orders is the most important. Now they have an employment number themselves and they have an inflation number, but typically what people look at is new orders. The reason the ISM is so important is that it's not looking back. It's a forecast what these purchasing managers are expecting next 6 months. So it's a good future indicator. Whereas the employment report is backward looking. Then you talk about the stock market, the bond market. Make sure you talk about the markets on that day. All right, that you don't, make sure the S&P was up 8 points, the Treasury yields were up 9 basis points. Make sure you have a graph in there to help with that. Make sure you have it on that day. Don't talk sense there. Now, could you add more? Your boss is reading this. Is it clear to her what the S&P's been doing all year? Maybe not. You say, hey, the S&P was up 0.2%, but I like what one paper did, but it was down X% that week. So it had been down the previous few days, and then it's, so while Friday wasn't a great day, at least it's one positive day after several negatives. You could talk about year to date. You could talk about where was the Treasury yield at 12/31/2022? What has it done this year? So giving your boss a context is helpful. If she's about to walk in and talk to the CEO, those are the kind of things that can make her sound a lot smarter, even though she's been all busy, running in. She's got a million things to do. Anything you can do off the top of her head, she can say those kind of things. And in other markets, you just got to decide what's important. Oil moved pretty high that day. Gold and the dollar could be interesting. Anytime employment numbers come out, it's going to impact gold and the dollar and probably in opposite directions. Small cap versus large cap. Small cap did really well that day, so that's somewhat telling you the market's interpreting that as strong for the economy. Those kind of things. You have to decide what else you bring in. Don't go crazy with it because there's stuff that moved that probably had nothing to do with the employment reports. So don't talk about pork bellies or something like that unless you can tie it to that employment number. And then I look at clarity and critical thinking. Clarities are some simple things. So one thing I count off on is really, really long paragraphs because they just look so unprofessional. So if you're using 2 columns with narrow margins, I wouldn't go more than 15 lines on a paragraph. So if you got 20 lines and you're not sure where to break it, just break it randomly. It doesn't really matter. But I wouldn't put two whole thoughts in the same paragraph. So if you're talking about the jobs report, 187,000, and then you're going to talk about unemployment rate, just break it. It's an obvious place to break, put a new paragraph. You can have a paragraph that's 4 lines long. It's better to have shorter paragraphs than longer paragraphs. All right. No double space. It looks so unprofessional. Good titles. And then the biggest thing I'm picky on, because I learned so much from my first boss in finance, is the clarity, avoiding redundancy. So one of the paper I was looking at talked about the participation rate without mentioning it. And in a later paragraph, started talking about participation rate without linking it back. So your boss can be, are we talking about something new? Or are you still referencing back to that? You know, make it really clear. Don't separate that participation rate, 12 paragraphs from the unemployment rate. If that's what you're using to distinguish it, put it all together. So clarity, and then don't say it 3 or 4 times. That's the other thing that's frustrating for your boss. You talk about participation rate or you talked about wages, and then you do it again, and your boss is like, okay, is this something new, or they're just repeating what they just said? And then they got to go back and look. And the worst thing is you're talking about the same thing, but you use slightly different numbers. Then they're really confused. Okay, wait, what is this? A different report, a different group? So make that really clear. I was talking to one student. One of the most painful things you got to do as a student is delete sentences. Students hate doing that because you get in your mindset more pages is better than fewer. But no, if you're not adding anything with that paragraph, it's not going to help your score. With me, I don't throw papers down the stairway to see how far they fall. So clarity is really your communication skill. I read it as if I'm your boss about to walk into the office with the CEO. Did you prepare me for that meeting so I can quickly know exactly what happened? That's the key. It's communication. And in critical thinking is, did you explain it correctly? Did you just use the right kind of words, the right kind of adjectives? Did you connect it together? Did you find some good resources to quote? Those type of things. So on this paper, so they do an intro. I like that approach on the quotes. Notice 2 columns I like, full justification I like. One thing to be careful of, if you use full justification, don't switch back to left. All right. That happens a lot when you do a quote. People forget to go back to full justification. So you want to make sure you keep it full justification or left. Don't go back and forth between the two. All right. And I'm doing that not for the grade, but that's for LinkedIn, because the HR people are going to look at this first, and that's probably the only thing they're going to notice. So then I start looking for the numbers. This person used the word encouraging, so they put an adjective in there. I think encouraging could make sense. So she did both months revised down. She talked about the consensus somewhere. I can't remember where. Now, if you put the table in there, I'll give you some credit for the number, but still talk about it, because I need that adjective. Was it give me a table doesn't tell me if it's strong or weak. All right. So I need to hear what the number is. So there's the 3.8. So the question is, do I see the expected? So I don't see the expected. It may be in there. Now, this is something, using a couple of paragraphs, a couple of sentences, students will do this, and it's probably my fault, but they'll spend a lot of time talking about what was expected and then give the actual number. I would just say the unemployment rate came out at 3.8%, above the expected 3.5%, and above prior month. I would just put it in there. Don't spend a lot of time. I mean, it's not wrong to say, hey, the market was expecting 3.5%. However, the actual number came out. That's just like a lot of extra words to say, the same thing. So try if you can get 3 sentences into one, that's really powerful. The graphs are very professional looking. That's what you want. Make sure it's legible. That's the one reason to keep the margins really, really narrow, so that graphs will fit a lot better. Okay, let's see. She talks about the labor force expanding. That's related to the jobless, the participation rate, and that's down here. So is there a way to connect those better? That's the thing you want to, because this number is tied to this number, but they're about 3 paragraphs apart. So how can you connect them? You could say, as discussed below about the participation rate, then you can put it in there. So you force it to be connected by just saying, as I talked about before, so that way they know, okay, this is not something new. They've already talked about it. That certainly helps. So here's the expected number. That's really far away. I don't know whose paper. I'm getting my students mixed up. I may be talking to the wrong person here. But yeah, so that number is really far from this number, and the unemployment rate's in between it. So that gets tough for your boss because now they got to shift back over. Now we're talking about this number. So if I were they, I would put the prior number up next to the 187. I would put it all together. Now the revise is important because we have 2 months revised. We're seeing a lot of months revised down. That tends to happen when numbers are worse than they really are. You could still add that sentence. It just means you're going to have more discussion of the 187 before you get to the 3.8, but that's fine to do. Private payrolls, they got that in there. I don't know if they have the actual numbers. So there's a 144. The number of private added in August was 140, which was then revised. I'm not sure I understand that because we're looking at August, right? So this sentence is confusing to me. What was the private payrolls? Y'all remember? I can't remember the number. So it's August couldn't have been revised because we're looking at August. August will revise October when it comes out again. So there's some confusion there. Could be my confusion, but so there's the 179. A lot of discussion there. I'm not sure they actually prior number, so make sure you get the prior number. So you can see I'm just going down here. And one way I can tell it's well written is it doesn't take me 20 minutes to find the numbers. So I'm reading a paper. It's like, okay, the number's got to be in here somewhere, and I'm looking for all over the place. Sometimes I'll do a search on the number just to see if after I've read through one time, I just missed it somehow. But if you wrote it well, that should be easy. It should just be blatantly up there right at the beginning, guys. That's what your boss wants to know. What did the jobs report do? Marketing implications, the S&P. Now, in reality, you don't need to explain what the S&P is, how important it is, although you can, but your boss already knows that. So in real life, I absolutely would not do that. If your boss thinks you're training them, they're not going to be real happy about it. Your boss thinks you don't know what the S&P is, that's not going to sound good. But for this paper, it's fine because you're kind of teaching yourself, which is found. So all three sentiment marketing showed upward movement. Market reacted positively. And the only key is if you can shorten this. You really have to say not many sentences. The S&P adjusted close, the market opened. It started at 50.45, reached a high 45.41, and it closed. There's 8 points. So he or she's got all of those. Again, don't switch back and forth. The Dow Jones, I'm not a big fan of the Dow Jones, but you can certainly talk about it. Here, the graphs are a little bit more difficult to read. So if you can use a graph like that, find some way to make it legible because I can't see those numbers on the right at all. Some charts, I can't tell what it is at all because it has dates or times at the bottom that I can't even read at all. And that's just like, what is that? So it's just kind of frustrating to try to get through it. All right, there's the ISM. Again, the ISM, if you're going to do the ISM, do it before you talk about the markets and put it up there. It doesn't really belong between stocks and bonds. But if you do the ISM, yeah, you can do something like this. I would probably highlight something in here so you know what it is. It's up, but it's not a radical number, so the market somewhat ignored it. It is down this last year from 51 to 47. 47 is actually a pretty important number, and they talked about that there. 43 is more important because 43 is somewhat of a recession number, but you know, you're getting closer to that 50, but we're well below 50. That's not a recession. That just means slow economic growth, kind of a soft landing kind of thing. Then the bond market, they again explain what the 10-year treasury is. You don't really need to do that. They have a chart of it. They decline while yields surge 9 basis points. So there's, you know, surge. That's probably okay. Maybe a little strong, but probably okay. One thing I think on bonds that just sounds so strange to finance professionals is a lot of students talk about the yield rising and imply that because yields rise, that had somewhat of an impact on price. And that's not the way bonds work. All right. You talk about, hey, strong employment report that had an impact on the stock market, it goes up. That's not the way yields and prices work. When you say yields rise and prices fall, you're saying the exact same thing. It's mathematically the same. You can either talk about yields rising or prices falling. They're the same thing. So don't try to imply that yields were up and the market looked at yields up and that caused the price to go down. No, they happen simultaneously. They're one and the same thing. So that's just a wording. Gave the ending yield, so that's good. And he's given a reason why he thinks the bond market reacted, or she's given a reason. So yeah, that's good to do. Just be as efficient with that discussion as you can. Brought in commodities and currencies. That's a little much, right? Can y'all read all of that? If you're going to have that much data in a table, that can be fine, but I would circle what you want. Is there anything in particular you want your boss to see? If not, or even if there is, if there's like one thing in that chart, you're probably better off leaving the chart out and just putting it in a sentence. And saying, in particular, you saw the US dollar do this. So, and then in conclusion, so this is good on the conclusion. Yeah, I think I know which one's which. So be careful on the conclusion. You don't just re-summarize everything. So if your conclusion 7 or 8 paragraphs, it's probably too much. So the conclusion, I don't even like the word conclusion. I almost like the word what's most critical, or what I see going forward, or what's most important, what's going here. You want to have something to your boss is saying, okay, I already know what you just said. Don't tell me all that again. What do you think is most critical in this report? As far as sources, yeah, you can do sources. I don't really check those, but it's good for you to have the sources so you can find this data going forward. So I'm not going to actually do this. Paper would probably do pretty well. Some points on the clarification, because it's I think every college student it's too wordy. There's places I think you can get one paragraph down to a sentence and 2 paragraphs into 1 paragraph. So what's that famous saying? I would have written a shorter paper, but I ran out of time. That's really what it needs to be. Each draft should get shorter and shorter and shorter as you get more and more efficient with your time. So on that paper, they probably would get their points here, although the prior there, I'm not sure. If you don't give the number, I mean, it's 100%, 100%. I mean, if I can't find it, it's not there. If it's in the table, I'll give you some points just because you put it in the table, but without the discussion, I won't do that. Same thing here. I think they did this one. Participation rate, they talked a lot about. Sectors. So was there one particular industry group that really drove this number? Right. So there was one sector that added 1,000 jobs out of 187,000. Nothing's not that important. Is there one that added 40, 50,000? That's what you're kind of looking for. The wages and hours, you know, look at those, put them in there, see if there's anything there. And then the other, just what else you can find. On the stock market, you got to have a graph. You got to talk about what it did that day and give some commentary on tying it back to the report. Why do you think the market reacted the way it did? Those are the kind of things I'm looking for. Bond market, you have the ending yield, how many basis points that it changed, and then what that meant for price. Don't give me the actual change in price. Just tell me where the price went up or down, put some adjectives in there, and then again, link it, like this paper did a good job of linking it back to the inflation numbers. And then what other markets, and don't just randomly throw them in there, but find markets that make sense. A lot of students will do whatever prior papers did. Or prior papers was a completely different market. So look, I did give you that PowerPoint out there that you can pull some of those markets, that data from. I'll try to cover everything. In clarity, this is the place where it's very subjective, but it's just my opinion that too wordy, not clear, you're kind of inconsistent, those kind of things. It's just not clear. And in critical thinking, it's just how well it's written. Can I tell that you understand what you're talking about? Right? So I won't give a full grade on this one, but it's a strong paper, but this paper could probably add 10 points to their score by making some changes between now and Friday night.
First thing, is it going to be on?
No, it's not.
Okay, after early class table, 127,000. And then lastly, for student example 3, the student's name is still there.
Yeah, because it was a PDF. Oh. And I couldn't take it off. But he gave me permission to put it out there. So yeah. All right. Yeah, I don't give you this rubric because it's in the paper description. If you look at the paper description, everything on this list is in that description. So, but you're seeing it certainly can help. The other paper, they put the table in there, so that's good. Just make sure you're consistent. So John Mark continues to show resilience in August with addition of 187 jobs surpassing expectations. Again, the prior jobs, where is that? So just make sure you have that in there. And then they're talking about, the uptick in the jobs number is an issue. They mentioned the 3.8 up here. So, and then they talk the participation rate right after it. So they connect those two. And then they added another chart. You can certainly do this. There are other ways to do unemployment. One is, okay, only 3.8% unemployed, but there's a lot of workers that want to work 40 hours and only working 20 hours. Discouraged workers, what's that unemployment report? That used to be a really big number a few years ago. Today, it's not as much, but you can certainly talk about that. Good use of titles, so you know exactly where you are. That's really good. So I talked to him about this one here. You got the participation here, and again here. That's the kind of time where you say, "Is this I just discussed or discussed above," or you take it out in one place. Ask, are you adding anything here that you didn't cover there? Are you just saying it all again with more words? Now here he's adding some stuff on age groups. So maybe start this paragraph to delve more into the job participation rate. I want to mention, and then you could bring that in and not repeat what he's already said. You could certainly do that. That's a good way to get rid of sentences. Here he's got the sectors covered well. And then he decided to do past report revisions all down here. So it's somewhat separated. And that's fine. It's a little, I mean, their boss is kind of expecting what was the prior here, but then she can see it right there. So you're probably okay. If I were doing this, I would say versus a revised prior $157,000, more discussion on that later. Just, I want my boss to know that, I'm going to talk about this again. So when they see it, they're not like, what am I doing here? But a reserve implication certainly makes sense. A couple of years ago, it was all about COVID, right? COVID implications and all that kind of stuff. Now it's the Fed. What's the Fed going to do? He may have to add something else, jobless claims or something for that week. He does get credit for this being one of those others, talking about the Federal Reserve. And we were talking, like, we know a whole lot more now than we did September 1st, but you got to pretend like you don't. Now, if you want to, be fancy and say, everybody's expecting the Fed to raise again, I actually think their next meeting will keep rates where they are. I mean, you can pretend like you knew that on that Friday. I'll let you get away with that. It's a pretty decent looking chart. I can see the time. He gives the information. He bolded it so the boss could find it really quickly. Brought in the Russell 2000, Dow Jones,
NASDAQ, tech stocks, then the 10-year Treasury. It's kind of, y'all know where the 10-year Treasury is today? Just a few weeks later. It's not at 417, is it? Everybody know where is it today? 455, a record for the last, it's hitting its high for the last several years. Just in the last few weeks, it's up another almost 40 basis points. It's pretty amazing. 8 bips, and I told them, yeah, don't use bips, BPS, not BIPS. So yeah, here's what I was talking about. This increase led to a decrease in bond prices. I would just say 10-year Treasury yields rose 8 bips, closing at 4.17% as bond prices fell. And then, just don't make it sound like they're two different things. The crude oil prices, the dollar and gold. And so, yeah, we talked about this. He might revise this. It's essentially summarizing everything he just said. And your boss is like, I'm just reading everything again. So can you somehow figure out what's the most important? So again, I don't like the word conclusion. Where we should focus. Now, what do you do at the title if you want people to really read that paragraph? And studies have shown a title with a question is read much more frequently than a title that's a statement. So what could be even more powerful? What comes next? Stuff like that, people will read. If you write what I expect to come next, they won't read it. You say what comes next, for some reason they'll read. That's true with links on the internet too. I don't know why people want to have answers to questions. So what comes next? What do I see from here? Those kind of things. And that's, you don't want to do that all the way throughout. That gets a little irritating. But your final conclusion with a question that, hey, you've read all of this. What's most important here? That gets them to say, okay, yeah, let's get to the bottom line on this thing. All right. So this is a strong paper as well. Both of those papers, it's just, they could really edit it down and say the same thing. I told you about my boss, man. He was so good about this. You could say things in 2 paragraphs that take me 3 or 4 pages. And I'd look at it and say, he said more in 2 paragraphs than I said in 4 pages. And why was that? Because one of the things I would do that was a really big mistake is I'd worked so hard, I'd done so much analysis, I'm really proud of the analysis. And I'm like sticking all that into the paper. And he's like, they don't care. That's why we're paying you. You can do your job. You don't have to prove to them that you did your job well. Leave all that stuff out and just tell us what you want them to approve. It's like, okay, yeah, but I want credit for all that work. It's like, no, that's not the purpose of the paper. That's what your boss does when he pays you. So, all right, questions on this? So become a great communicator, and we do a lot of communication in writing. Get much better. I wish we had a technical writing class just for business majors. It would be really, really helpful. But I don't know if y'all taken technical writing. I'm sure UTSA has one, but it's not can be too helpful because scientists, technical writing, their goal is to document it so someone else can redo the whole experiment. Finance, your purpose. It's not like you can document it so they can see whether you're right or not because there's so much subjectivity. You're trying to convince them, you're trying to sell them on something. So it's like communication. So the paragraphs are shorter. It's much more to the point than a science paper. So there's no maximum. There's no minimum. However many your boss, never ask your boss that question. So yeah, you just however's long enough. That's part of the critical thinking, right? You got to decide what goes in and what doesn't go in.
So for those examples, what you say they're strong? Like what kind of grade was it strong?
They're both at least a B to start with, and you could easily add 10 points. And so they're probably B plus A minus right now, and you could probably add a few more points. And most of it's on the clarity, just getting it more succinct would help a lot. Any other questions on that? Does that help to look at papers? Y'all can see. All right, so let's finish up alternatives. So we talked real assets last time, real estate, timber, commodities, and then all those specialized ones.
So there's a lot of other things we could add. We talked about infrastructure. There's a lot of other things and alternatives. The only other one I want to add though is private equity. Or venture capital, I should say private equity, but private equity is the big category. So private equity just means investments where you're an owner, but it's not traded on the stock market. So private equity, and then venture capital is a special type of private equity, which are startup ventures. You're starting them up from scratch. So it's a way to buy small companies where you don't get that daily price fluctuation. So private equity looks real smooth, even more than real estate. Because real estate, you do get some appraisal jumps around, but private equity, it's an incredible guess what any asset's worth, especially in the first few years. So it's who knows what the market's doing. They have what they call a J curve. A J curve is, so a typical private equity investment will be 10 years. So you make a commitment up front. Let's say you make a $300 million commitment. You don't give them $300 million. You just commit. And then as they make investments, they'll make cash calls. Say, we need 25 million, we need 50 million. So it may take you a year or so to get fully funded. And then the contract itself is for 10 years. And so what they're saying is, yeah, somewhere around year 7, 8, 9, we're going to start doing these IPOs. And we'll start making these things go public. And you get the J curve because the first few years it's just negative cash flow. You're just sitting them cash. And then suddenly around year 5 or 6, you see this sharp increase in cash as you IPO and these things start going public. Now, IPO, y'all heard of IPO, initial public offering. What other choices do you have besides IPO? There's two that come out. Yeah, heard of the acronym SPATs. What are they? No. I just forgot. Direct listing. So y'all should do this, but I didn't. Let's see. How do you spell that? I just forgot. SPAC. It's a C. Man. Yeah, my brain. If people are looking at me, my brain doesn't function. So an IPO is initial public offering. You get an investment bank. They're going to spend all this money and advertising and get it all set up. A SPAC are these special purpose entities that were real big a few years ago. They've kind of gotten a little tainted, but it's a way to do it in kind of a specialized way and kind of a private firm that's going to, kind of get you started. A direct listing is firms that say, forget the investment banks. We're just going to put our shares out there and see what happens. There's been a few of those that have been pretty interesting. SPACs and direct listing didn't exist when I was in finance. I'm not familiar with those at all. The SPACs especially are just really bizarre to me. It's kind of an unusual thing. And the direct listing, who was it? Was it Spotify that did the direct listing? Spacify, what is that?
Yeah, they did.
So you might look them up and see how it went. It's somewhat dangerous because you're doing something that really hasn't been tried before. The investment bankers make a lot of money off these deals. So obviously, they don't like this approach, but they do add some value. How much value do they add is pretty questionable. I don't know if y'all have ever read the book Barbarians at the Gate. Doesn't give a really pleasant picture of this particular market, the IPO market. So IPO versus direct listing, Investopedia talks about that, and SPACs are probably in here as well. Do you need to know these? I mean, it just depends. If your firm that you're interviewing with does this type of thing, then yeah, if you're going to interview with a private equity firm, I would definitely want to know that. So at USAA, my experience is pretty limited. So I went over to the investment firm as an analyst, and USAA had a private equity portfolio, but it was really small. I think it is less than $1 billion. It was a really small portfolio. The lady who was running it, she brought it over literally to me in a shoebox. She handed me a shoebox, says, here's our private equity. So I took it and put it all into Excel. I was looking at it.
It was interesting. It didn't make us a lot of money. It was a lot of work. It made us about the same as if we just stuck it in the small cap stock market. But it was interesting. The coolest thing to me was when they went IPO, because my job was to decide when to sell them. So I did an analysis. When should we sell these? 1 week out, 2 weeks out. And we had some pretty good sells. Medtronics was one of the ones. That's a pretty big firm. Charles Rivers was one of them. So we had some pretty big names that came out. And then it just dwindled after that. The president of the investment company, his opinion was, we're going to do private equity. We should invest in one firm and just hope for a home run. This idea of investing in 20 different partnerships and hoping you're just kind of spreading your risk. His idea is either do $200 million starting a new firm and just hope it's the next Microsoft, or we just don't do it at all because it's just not worth the effort. So we pretty much shut it down. It got to be almost nothing there. I don't know what they're doing now because they have a whole new department that look at this kind of stuff. But so can you make money in this industry? Yeah, most students won't start on this side unless you want UT Austin or MIT or Harvard. So there's certain places like Boston and Austin that have a lot of private equity, and they're right next to major universities. So at Austin Private Equity, they're probably going to hire all UT Austin people. In Boston, they're going to hire, the big MITs and Harvard types. Could you get a job in that? I have some students working in this area. They didn't start there, but they were able to get there. I have one up in Austin now that's working for private equity. So you can, but it's hard at UTSA to start there because they don't have big staffs to begin with. They don't have hours and hours and hours to do college recruiting, so they tend to just stick. They know professors at UT Austin, and they're just like, give me your best 3 students. I need 3, and that's their entire process. So it would be tough to do that, but you could get there eventually. It is a very different world. It's probably a little less stressful of public equity because you don't have the daily fluctuations, but you do have the long nights, and it is stressful. We have one student, one that's trying to start a new private equity to do it much, much differently. He was showing me his model. Sounds interesting. Sounds like an incredible amount of work. You want money showing up in hundreds of millions of dollar increments, and he's trying to do this with money showing up in $1 million increments. So I don't know if it's going to work or not. We have another one up in Denver, and he's doing cannabis IPO. He's doing cannabis private equity. Pretty interesting. I was like, how did you handle 2020? So, we did great. People were using a lot more cannabis during COVID. So we actually did pretty well. So, okay, that's interesting. I don't want to hear too much about that, but that's a pretty tough private equity, isn't it? Because you have banking laws where it's essentially illegal federally, but in the state it's legal. He has to get around all that. And so he's very much specializing in one particular area, and they're doing well. So private equity could be your career, but probably not starting off. If you really want to do private equity, the best thing you can do is figure out where most of the private equity is. So it's technology, it's fintech, find out in healthcare, there's certain areas, and start working on the corporate side in that area. So you can learn that industry. So if you're working for a tech company or fintech company, and then you can move over to the private equity because you have that direct experience. That's what they're looking for. They need industry knowledge more than anything else. Or go work in Houston for Exxon or Chevron, and then do private equity on the energy side. That's that. And how long do you have to work there? Well, 2 or 3 years is probably enough. You'll learn to make sure you're working in the right places. But if you're working in the right places, learning the industry, the ins and outs, then you could very easily move over to the private equity side. They pay well. You got to associate yourself with the right people. So find a boss that scares you to death because they're so knowledgeable, and that can be a good career. All right. So what else is there? Hedge funds. I don't consider hedge funds to be alternatives. To me, hedge funds are either alpha plays, which means you're hiring a hedge fund to try to beat the market. We did that at USAA. We hired a hedge fund just to add to our return. So sometimes they were market neutral. So what they were doing was going long and short stocks and just trying to be long on the stocks going up and short on the stocks going down.
So is that investment in the stock market? Well, no, because we don't have exposure to the stock market, right? For every stock we're long, we're short on another one. So the stock market could fall 40% and we still make money. So that's not a stock market investment. That's an alpha play. We're trying to beat the market. So hedge funds to me are just really alpha plays. One thing you could look up, which I think it's died down here recently, but it was a big deal for quite some time. It's just search alpha beta separation. They're asking the question here. So alpha beta separation is a really cool idea. So the idea here is you go to Fidelity, you want to hire a large cap stock manager. And you say, I want you to beat the S&P 500. Well, their only choice is to take all the stocks in the S&P 500 and overweight and underweight them. Their entire universe is large cap stocks. That's all they can do. So if they really like Apple, they can buy more Apple. If they don't like Microsoft, they can underweight Microsoft. But that's somewhat what they're stuck with. With alpha beta separation, you go to Vanguard or BlackRock and buy an S&P 500 index fund. And then you go to hedge fund, you say, go long and short anywhere in the world. It could be Apple and Microsoft, but it could also be the Canadian currency and the US currency. It could be oil and natural gas. So they have unlimited ability to go anywhere around the world to try to add alpha. They're not limited just to large cap stocks. So that's what alpha beta separation is just buy the market and then hire a hedge fund that had alpha and let them do anything they want to in the world. Y'all know the major hedge fund strategies? So long short equity could be equity. A typical one is 130-30. So they have $130 million long and 30 million short. That's 130-30. That to me really is an investment in the stock market, but with a heavy emphasis on alpha. So that one kind of could work. Merger arbitrage. These are companies that when someone announces a merger or an acquisition, you'll see the stock of the acquiring firm, the firm that's being acquired, you'll see their stock price shoot up. So maybe someone bids $40 for a stock that's currently trading for 20. If the stock doesn't go up to 40, it goes up to like 38. Why? Because it may not work out. Well, merger arbitrage, what they're doing is taking advantage of that extra $2 to try to make you some return. Convertible arbitrage was real popular some time ago, but it's those convertible bonds that convert into stocks, and they're looking at the mispricing there. Fixed income arbitrage, there is really no such thing, but that they're going long and short on fixed income securities. There's no arbitrage. These words arbitrage are completely misnomer. That doesn't go. Global macro is one we did quite a bit of at UTSA. And global macro just means they can go anywhere in the world, go long and short, but only at the market level. They don't do individual stocks. So they may be long Germany and short UK, or long the dollar and short the yen, long gold, short whatever. Global macro, anywhere in the world, they're long and short. So they want to buy the stuff that's going to do better than the stuff they go short on. I don't even really know what short only means. That's kind of ridiculous. And there's many others besides those. Do you need to know those? I don't know. If you're going to interview with HEB for their pension plan, yeah, you probably need to know these things. If you're going to interview with a large kind of private pension kind of plan, they're probably doing hedge funds. You probably should just know the major strategies. This one's missing quite a few. Free investment banking course. There you go. You can see here some of the largest ones. I remember at UTSA, my first hedge fund, the partner we're talking about, because our CEO, he approved nothing. So it's like, well, let's take it to him. He's not going to approve it. Yeah, but let's ask because we really wanted it. So we go to his office and he's like completely distracted. He's like, yeah, whatever I want. It's like, well, did he just approve it? Yeah, he just approved it. Let's get out of here as fast as we can. So we got it. And we were so lucky because usually you hire a hedge fund and they have the worst year ever. It's just the Murphy's Law. We hired a hedge fund. They had their best year ever. We were so lucky. It was really
just perfect. We couldn't have timed it any better. Not because we were smart. We're just completely lucky. But yeah, we were shocked when we left the room. Derivatives to me are not alternatives. Derivatives are just another way to invest in the market. We'll talk about options and futures later, but I don't consider them a hedge fund. They are, I mean, a alternative. They are a way hedge funds execute those long and short strategies, definitely. Are currencies an asset class? There are people who do currencies as an asset class. Where you can look for here is just search on currency overlay. So currency overlay, what they do is, let's say you have a global stock portfolio. So you're investing in stocks around the world, and you're just buying Japanese stocks, you're buying European stocks. So you're exposed to the euro and the yen. So if you put 20% in Japan stocks, you got a 20% allocation to the yen. So your allocation to stocks is the same as your allocation to yen. And then you hire a currency overlay manager and you tell them you manage the currency. So they say, oh, you got 20% to the yen. Well, we hate the yen. So we're going to short the yen and buy whatever, the euro. That's what a currency overlay manager does. Almost all of them are PhDs in economics, because that's what currency is all about. So market neutral is another hedge fund strategy. It wasn't in their list, but that's where you're long and short, but 100%. 100% long, 100% short. And why do they call it market neutral? Because you have no exposure to the market. You don't care if the market goes up or down. You just want the long stocks to go up more than the short stocks, or the long stocks to go down less than the short stocks. So it's a market neutral. They should have a beta of 0. That's their goal, is they're unrelated to the market. So it's an interesting strategy. USA, we did market neutral and global macro almost exclusively. All right. So that's the end of the what. It's a few years to get through it, but that's the end of the what. So let's talk about exam 1, question 1 more time. Got to be in your own words. Do not do any copying and pasting. You're going to get a lot of zeros on the exam question 1. Put it in your own words. If there's too much overlap, then you're going to lose a lot of points. It needs to be well organized. I've somewhat given you an outline. Define the portfolio. Why, what, how. On the what, you can go into major asset classes and break down in BCSI and bucks. So I've given you all of that. Remember, on the asset classes, you're going to talk definition, subcategories, and strategy. That's going to be true as you go through. So make sure it's well organized, logical, and integrated. It needs to be professional. Look, so you're writing to someone that's somewhat knowledgeable, so you don't have to explain too much specific, just don't go too low of a level of explanation. It should stand on its own. So if you're to hand this to someone else, they should read it and say what you're talking about. All right. So have it read well. If you want to throw extra stuff in there, that's always good to do. I don't really give a lot of bonus points, but it certainly doesn't hurt on the paper to do that. Does everybody understand the question? I'll try to put it out this weekend what the actual question is, but you already know the answer, so you don't really need the question. So everybody understands you're going to write this yourself in a Word document. It's going to be 2:30 on the day of the exam, and then we're going to do this next question in class. Everybody understand that? There's always 3 or 4 is like complete shock that I didn't know that's what you wanted. All right, so let's talk to tacticals. No questions on question 1. Let's talk tactical. This is question 2 in the exam. We'll do it in this room the first 30 minutes of the class day that we have the exam. So I'm going to give you a scenario, and you got to tell me which asset class, and I'll give you the asset classes. So you have a list of asset classes in a scenario. You're going to tell me which asset class is overweight and why. Okay, that and why is really important. This isn't a true false, overweight, underweight. You're just guessing. You have to tell me why. So the key components of your answer Stocks versus bonds, that's tied to the overall economy. Within bonds, you got duration. That's related to the direction of rates. Does your boss think rates are going to rise or fall? Convexity, that's related to the volatility of rates. Quality, that's tied back to the economy. If you think about it, the direction of rates is tied to the economy as well. We usually think rates are going to fall in a recession and rise in a strong economy. But the really unknown one is volatility. I'll have to tell you that one, but I'll just give you a hint on all of them. Then you have taxes there. I just give you the tax rate and yields, and it's the only math problem on the exam. You got to tell me which you prefer. Is there anything on inflation? I know tips didn't do all that well in 2022, but you just have to think tips will protect you from inflation. What does your boss think about inflation? Structure is probably not going to be there. You will not be there. U.S. versus non-U.S. bonds not going to be there. So there's some asset classes I'm not going to put on this second question just because they're just it's just hard to put them into a question. For stocks, everything on stocks has to do with the economy. Beta, you expect a strong economy, go cyclical, a weak economy, go defensive. Capitalization, expect a strong economy, smaller cap is better, a weak economy, lean more toward large cap. Style, expect a strong economy, value will do better because those are weak companies are going to do better. Expect a weak economy, growth will probably do better. And then US versus non-US. On that one, I have to actually tell you something. You'll see in the examples when we do. I'll have to actually tell you. You can't just guess which country is going to do well. And then alternatives. Remember, alternatives, especially real assets, can protect you from inflation. If I say something about a weak dollar, what alternative comes to mind there? You might do some gold, right? Gold does really well when a dollar is weak. Or I might talk some specific issue I might give you. The boss might say, I'm really worried about real estate prices in the US with mortgage rates rising, so you might underweight real estate. All right, so a lot of times I just give you one. How many things are there? There's going to be probably 18 things that you got to talk about. Why 18 things? So right there, stocks versus bonds. That's the one that's actually not on my list. I'm going to give you asset classes, but I won't give you that one. That one you just got to know. Pretty obvious. You're expecting a recession. What are you going to do with stocks? Underweight or overweight? Underweights. Pretty obvious. So there's one. On treasuries, you've got duration and quality. So treasuries, it could be a long-term treasury and that's high quality. So you got two things going on there. Are rates rising or falling because it's a long-term bond, and it's high quality. You're expecting a strong or weak economy. So there's two things on the treasuries. So you'll see as we go through here, there's an obvious list of what to do, and we'll get a lot of practice on these. So let me give you. All right. So yeah, here's the list. Let's see. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16. And then alternatives could be 1 or 2. So it's going to be 16 at a minimum bullets you're going to have in your answer. You may have 18 or 19, depending on what I do on alternatives. All right. So just know you're going to have 16 bullets. So let's practice it. So here's an example. So where do I get these scenarios from? I usually steal them from Sept because I'm running out. My views haven't changed too radically, so I don't want to keep giving you my views. So I'll go out and steal somebody's. Once I went out to Ken Fisher and brought his in, you already kind of know what he's going to say. Once I used to write the outlook for USAA, so I went to the USAA site. And John Spear had written theirs, so I just stole John's and reworded it into the exam. So I'll probably find somebody's and just copy it in and reword it in a way to make sure it has all the pieces. So I don't know whose this was, but your boss has said, I believe the recent good economic data is genuine. Does that sound positive or negative? Sounds pretty positive. I expect surprises on the positive side. Are you hearing stocks or bonds now? Stocks, high quality or low quality? Can you go down in quality? Sounds like it. U.S. economy with higher economic growth and lower unemployment. Inflation should remain well contained. What do you think about tips? Probably don't need them, right? But interest rates should rise. What does it tell you about duration? Shorten or lengthen? Shorten duration to more normal levels. Emerging countries should see very strong economic growth. Why do we care about stocks? Growth. Economies that are growing, you want to be in their stock market. It's really simple. Now, I could say, hey, emerging markets expect strong growth, but their stocks are already grossly overpriced. But I'm not going to tell you that. If you see strong growth, go for it. Right? Yeah, you do want to look at valuations. They could be overpriced, but you're probably, if you expect a strong economy, you're probably going to want to be there. Europe should continue to see very weak growth. All right. So I kind of told you developed markets. I didn't say developed markets, but you should know Europe, Japan, Australia. Those are the big developed countries. Very weak growth. US dollars should strengthen. We should expect some volatile periods. Now, don't get stuck on this word volatile. All right. Some students, remember with convexity, you want to buy convexity if interest rates are volatile. You want to sell convexity if they're going to become less volatile. I didn't say volatile interest rates, though. I said things are going to be volatile. I didn't really tell you about interest rates. So don't jump on the word volatility and assume I'm talking about interest rates. They want some added diversification, so that might argue for some alternatives. The marginal tax rate's 30%. Ignore the effective tax rate. We're making a marginal decision, so use the marginal tax rate. So we can move down in quality. Why? Because we're going to get higher returns. We're getting paid for that. We want to shorten duration. We prefer U.S. and emerging over developed markets. All right, so there's one. We'll do. So here, so U.S. long treasuries. You notice there's 2 bullets under that. So I gave you long treasuries. So this is where students really get messed up. So U.S. long treasuries, there's 2 things there. There's the quality. So what kind of quality is long treasuries? Very high quality. And then there's duration. What's the duration here? Long term. So we just talked about a strong economy with rising interest rates. What do long treasuries sound like to you? About the worst place you want to be. But why? You got to tell me why. So you can't just say underweight long treasuries. You get 0 points for that. You don't want to just say underweight long treasury because rates are rising. You want to shorten duration. You get 50% there. You got to talk both about the fact that it's high quality because they're treasuries and they're long duration because they're long term. All right. So there's 2 of those 16 buttons right there. Everybody seeing that? You're going to say, I'm underweighting U.S. treasuries, long treasuries, because they're high quality. We don't need high quality in a strong economy. And they're long duration. Interest rates are rising. I want to shorten duration. Then you get full credit. Everybody with me on that? Someone didn't hear that. Everybody see it? Right. I have heads going like this. I don't see them going like that. So I'm assuming those that aren't shaking their heads are going like this. Okay. Then you get to munis. You notice there's 3 things under munis. Munis versus corporates. The first thing is medium quality. Can we do medium quality? Strong economy, medium quality do fine. That sounds good. There's short term. Rates are rising. The short term sound good. That sounds good. And the only thing you have to do is see if the munis are better than the corporates. So the munis are short term, the corporates are short term. The munis are medium quality, the corporates are medium quality. So the only thing we have left is which one you prefer. So munis have a yield of 2.6%. The corporates have a yield of 2.9%. So you take 2.6 divided by 1 minus 0.3, you get 371. That's higher. You'll see that. We'll do that numbers. Median quality is okay because the economy is going to be strong. Short term is good because rates are rising. And then this is not a 4th one. There's only 3. So once you say you want to have more munis and corporates, you've kind of covered that in this bullet. So that's not, don't count that as part of the 16. So you can talk about the munis and corporates all together as one group because it's really, they're exactly the same bond with the exception of the tax preference. Stocks overall, strong economy, overweight. Then I have U.S. large cap, low beta. There's 2 things there. They're large cap and they're low beta. You got to talk about both of them. All right. So large cap, strong economy. That's fine, but I'd rather have small cap than a strong economy. So I'd probably underweight. I mean, I'm going to have stocks. I'm going to have a weight to large cap, but I'm probably going to be more overweight to small cap than large cap because of a strong economy. What about the low beta? Low beta defensive. Do we need defensive stocks in this environment? No, it's a strong economy. We need to go cyclical. So underweight. Then we have small cap, high beta. Small cap, yeah, I want to overweight those. So here's something, make sure you get in your notes on large cap. I might actually overweight them, but not nearly as much as small cap. So what you want to say are the words within stocks. Within stocks, I have a preference for small cap over large cap. So you could say that right here. Within stocks, I prefer small cap over large cap given the strong economy. Then you get the bullet count for large cap and you get the bullet count for small cap because you set it all together. In high beta, we like that as well because it's a strong economy. Developed markets, we don't like that because Europe's going to be weak and the dollar is strong. So you see on the developed markets, that's where I want you to talk about currencies. I don't want you to talk about currencies on the emerging markets because it's a really mixed bag. There's a lot of emerging countries that are kind of tied to the dollar, and there's other things going on, especially with commodities in emerging countries. So the only place I want you to talk about the dollar is under developed markets, and I'm going to keep it consistent so that the two go together. It's very confusing because a weak economy will have a weak currency, and that weak currency is going to help the weak economy because it's going to make their exports cheaper, and so it's going to, so it's this big circular thing. But I don't want you to get into that. I'm telling you, the economies are weak, and the U.S. dollar is going to be strong. You don't want to be in developed markets. Emerging, pretty obvious, although students miss this on the exam. Your boss thinks emerging countries are going to do great, so over-allocate emerging countries. That's pretty straightforward. That'd be a horrible point to miss. And they said they wanted some diversification, so alternatives may help them with that. All right. So here's another one. So how is the strengthened economy dominates this? That's the first thing you want to find out. So how strong is the economy? Which direction are interest rates going? Are they getting more volatile or less volatile? What's the view on inflation? That covers like 80% of what you need. So here, I blame, this is during the fiscal cliff. We're almost back to another fiscal cliff with Congress loves playing along the cliffs here. In Europe, sovereign debt crisis is going to send the U.S. into a recession. They really got that wrong, but a recession. That's pretty negative, all right? You're going to want higher quality. You're going to want bonds. With Japan following suit and Europe continue to be in recession, economic and corporate earnings growth will be well below historical levels. Emerging companies should see decent growth. So right there, emergings may be the place to be as their consumers begin to spend. Inflation should remain well contained. I expect interest rates to stay in a very tight range. So what does that tell you about the volatility of interest rates? Very, very low. They're going to stay in a tight range. So you could probably sell convexity in this environment. Take advantage of those higher yields on mortgage backs. I think rates will be even less volatile than currently priced. With most of the developed world debasing its currency, I think the U.S. dollar will hold up well. I'm not concerned about inflation. I'm not sure diversifying real estate at this point makes sense, as these assets are already pure expensive. So there are alternatives. You just say underweight real estate. On alternatives, I don't give you a list always of all the alternatives. You just have to know real estate's an alternative, and you probably want to underweight it. Tax law changes, and then gives the tax rules. So long treasuries. So this one's a little tricky. That's a recession. I didn't tell you if rates are falling or not, but they're probably going to fall. Long treasuries could make sense, but in this case, because rates can be so stable, I'd probably overweight mortgage-backed securities. But you could argue here, overweight long treasuries because of the weak economy. However, I probably have a preference for mortgage-backed. So there's different ways you can get points in this particular scenario. So the long term is okay because rates are stable. Why is stable rates okay for long term? Well, remember the yield curve is usually upward sloping. It's not today, but it's usually upward sloping. So longer term bonds usually yield higher than shorter term. So if rates are going to be stable, you get to lock in that higher yield on longer term. So that's the reason stable rates are great long term. Municipals, You do the tax effective yield, recession. So this is high quality, so they look good. Rates would be stable, so longer term is fine. Mortgage backed, sell convexity. Make sure in your answer, if you say you want to buy mortgage backed security, it's because you want to capture that higher starting yield. Okay? That's very, very important. Remember, if the yields were the same, you would never buy mortgage backs. You'd always buy the treasury. Why take all that convexity risk? So you're buying the mortgage backs because you get an extra 25, 50 basis points in yield. Underweight stocks because of recession. Large cap. So what words you see right there? Within stocks, I like large cap. I like low beta within stocks. But I may be underweight large cap, but I'm going to be much more underweight small cap. So that's why that within stocks is so important. And there's two things there. I didn't do two bullets, but I like the fact that they're large cap, and I like the fact that they're defensive. Small cap, here's only one thing here. I'll give you two on small cap, but here's only one thing. Underweight, because they're small cap. Developed, underweight, because slow economic growth. The US dollar is going to do well. Emerging, overweight. And then maybe add some private equity, because she didn't want real assets. She didn't want real estate, but she wanted some diversification. Is private equity good diversification? I don't think it is, but a lot of people do because it doesn't fluctuate around like the stock market does. It's kind of artificial diversification because of the way it's reported. But all right, here's another example. So what I'll do on Thursday. We have a team competition on Thursday, right on Bucks. I don't know how many we can do. We may spend quite a bit of time on this. So I'll print out a previous exams question to you, maybe a couple of them, and we'll just walk through that in detail. Some students really bomb this question because they just don't understand they need those 16 bullets plus maybe two more. So I should probably show you some prior student questions, but I don't think I have any. Their answers because it's pretty weak. I don't know why there's not a connection on this question to what you need to do. So I'm going to try to overkill, make sure you're ready on this. What do you need to learn for this question that you didn't get out of question one? Absolutely nothing. Everything you've got for question one is in this question. So there's nothing new to learn. You already figured all that out. So all right, so we'll practice more on this as we get into it. So if you got this question interviewed, I got 500,000. How long would you be talking? More than a minute, right?
Yeah.
Longer than maybe 3 months ago you would have talked. But I really think that's the key is that you can, off the top of your head, just conversationally, your mind can just picture it. You got the Bucks and the DC cut side, which helps, but it's that comprehension. All right, so let's talk this tactical. So what I want to show you is essentially how this looks. In real life. So we did this at USAA. We had portfolios that had a strategy. That was the policy. The policy, this is what we normally do. We might update the strategy once a year, like with the pension plan, we go to the committee once a year and say, hey, here's our, it doesn't really change every year, but we reapprove. So we're going to be 70% this or whatever. So that's your strategy. And next to that is your tactical. Where are we today? So my job at USA, we started doing this when I moved over to the mutual funds. One thing that really bothered me on the mutual funds, we had the sales force that was selling all of our products and they never talked to the portfolio managers. So they're just making stuff up. Like, what do y'all recommend? They're just like, whatever. So one thing we started was we called it the USA Investment Group. We met every single month and we had detail on exactly what do we believe. And we communicated, we started doing these breakfasts. I can't remember if it was once a month or once a week. We did a bunch of them. But we rotate between the group of us who would present. We say, hey, we're avoiding developed market stocks right now just because we're really worried about Europe or whatever. We present that to the sales force. So they know exactly what we did. I think we presented to them monthly, but we brought a report every week. Every Friday, we sent stuff out. We actually published something on USA.com saying, here's our views. We wanted everybody to know what we were thinking. So make it really clear. The sales force didn't have to agree with us, but they had to give our spin. So we wanted everybody on the same page. And it was great. The sales force loved it. They see me in the hall and they come debate with me. It's like, I don't think you guys are right or whatever. We loved it. And we went on that back and forth conversation so everybody's really clear. But we had a document that showed here's what is our normal, and this is what we are today, and this is why. So here we got high quality bonds. We have a little bit of allocation there. We're not over or underweight there. But we might, if we're expecting a recession, we might go 10% there and get out of high yield. And what would be your rationale? Expect recession, steep yield curve. Those are the kind of things we'd write every week. It got a little redundant, you're writing every week because your views don't radically change all that much. But a new data would come out and we had to talk about the jobs report or whatever, the Feds, what the Fed's doing. We try to come up with something creative. I would always do the first draft, and then Cliff was the editor. I was head of equities, he's head of fixed income. We had a pretty good working relationship. You would have thought we didn't like each other, but we liked each other a lot. But it was very honest working relationship where he would tell me, yeah, that's a really stupid title, Ron. I don't know why you would say that. Or he would change something. We went back and forth with the wording. Once the two of us got it right, we sent it to the whole committee and say, this is what we think. The whole committee maybe not agree, but we had to agree as a committee. So we had Arnie, who was always bullish. We had Matt, who was always indecisive, but usually bearish. We're kind of fighting back and forth. So we have to have some kind of rationale, but that would make sense, right? If we expect a recession, what would we maybe do on duration if we're expecting a recession? Shorten or lengthen? Short. Well, think about it. What do you think is going to happen to interest rates in a recession? They generally do what in a recession? Generally fall. So what might we do with duration? Might lengthen duration. So we might lengthen duration. What if you're expecting a recession? What would we do on value stocks? Ignoring GMO, what would you do on value stocks? Underweight, right? They're low quality, so we might go 8 here and 15 there. What about small cap, mid cap? Might underweight those. Develop just depends on what you think, right? Emerging probably under on that. We might actually even go. We might go 10% over on bonds because we're expecting recession. No, that's the kind of things you do. You have that rationale. And firms do this. I've seen several. Probably my favorite was Western Asset. I think they're a Legg Mason firm, but Western Asset, they're a California firm, bond investors. So every time we met with them, they came in with this report and looked exactly what you were doing at DC cut side. So they the first page, so they showed us 2 pages. One was what the historical performance are. So the first column says, this is what we thought, this is what we did, and this was what happened. So we are expecting rates to rise, so we're short on duration. We're expecting rates to be more volatile, so we were over on convexity. We're expecting a recession, so we had higher quality. They just went through the whole DC cut side. So we thought this was going to happen. This will actually happen. This is the result. So we were right on duration, but we were wrong on credit. So being right on duration, that added 7 basis points to our return, but on credit, we underperformed 12 basis points. So net, we're under by 5. I loved it, went right through it. And then the next page was what? What are we expecting going forward? So going forward, we're expecting this, and this is what we're going to do. So we knew exactly what they were thinking and why. They gave us a rationale. They actually brought with them an economist. So their economist came, and he was a really sharp guy. I always liked talking to him. Sometimes firms have an economist just for show. He's talking and everybody's doing their own thing. But at Western Asset, their economists help set their strategy. So you essentially up and down on this. You're just, what is your opinion on each one of these asset classes? It has to add up to 100%. You notice I don't have cash in there. I could add cash to say if you just want to park cash on the sidelines for a while. But every asset class has their expectation, their rationale, and all the way down. Oh, am I not on Zoom? Sorry, I thought I was. It should be, yeah. Thanks for reminding me. Yeah, it should be recorded. It's automatically. Yeah, but thanks for checking because I'm getting out of the habit. All right. Could you do that on your own personal portfolio? Yeah, you should. Actually, Soros, that's what he calls it, his investment diary, which I highly recommend that you do it. Because what happens with the brain, our memories are terribly unreliable. Our memories remember whatever makes our egos bigger. We remember stuff that makes us feel smarter. And so we remember stuff that worked well. We remember that as, wow, I was so smart. I saw it was coming. And then when stuff doesn't work well, it's like, oh, that's just bad luck. And then we do the opposite with our friends. When something good happens to our friends, oh man, he was lucky. When something bad happens to our friend, oh, he deserved it. He wasn't really doing it for. So our memories remember things and make us look smarter than we are. And what does that do? That makes us make bad decisions going forward. So what Sorrell says is document every decision you made and why, and then go back and grade it as brutally honest as you can. So if you said, hey, I'm going to do this because I'm expecting X, instead Y happens, but you still luck out and make money, were you lucky or smart? You're lucky. You're expecting X to happen, Y happened, but you still ended up. And a good example was the Trump election. Everybody said Trump wins, the stock market's going to crash. Trump won, and what did the stock market do? Shut up. So you say, hey, I think Trump's going to lose, the stock market's going to shoot up, so I'm going to bet on stocks. So you bet on stocks because you know Trump's going to lose. He wins, stock market goes up. So see how smart I was? I knew he was going to win, and the stock market was going to go up. I mean, that's not the way to do it. Sorrell says you've got to be brutally honest because your decision making, if your decision making is flawed, but you don't remember it correctly, you're going to be thinking you made the right decision. You can keep making the wrong decisions. So I love what Annie Duke says. You should read Annie Duke's book. She calls it resulting. It's a great term. Have y'all read Annie Duke? Thinking and Bets. Great book. She calls it resulting. She says we assess decision based on outcomes, not based on the decision quality. We assume a good outcome means a good decision, and a bad outcome means a bad decision. He says that's absolutely not true. It's, you know, if you have a good decision-making process, it may give you a 52% edge. So flipping a coin, you got a 50-50 chance, but if you have a really good decision-making process, it may give you a 52% edge. That means you can have a good decision and be wrong 48% of the time. And she says you can't grade your decisions based on the outcome. She would ask people, what's the best decision you made last year? And they'll come up with something where they made money. It's like, was that a good decision or were you lucky? If someone said, oh, the best decision I made last year was I bet my entire net worth in Vegas and I won. Does that sound like a good decision? Sounds like a lucky decision. That sounds like a bad decision. But what if I tell you, oh, this good decision, so what did they do next year? They bet their entire net worth again, it's not going to work the next time. So that's the whole idea of a decision diary. Keep track, and if you start doing this, you'll be so far ahead of everybody else 10 years later because you'll start understanding why you made a decision the way you did. So that's Sorrell's idea. I don't know how accurate he was, decision diary, but keep track of every decision you make and then go back and brutally assess it.
You think Sorrell's mean George Sorrell?
Yeah. He says he does that. I can't confirm that he actually does. All right, so your next paper, we'll start talking about it after we get your first paper, but it's an earnings report. And so I'm going to be looking I'll give you a list of companies to check from. So if you're going to do an earnings report, if you've never done an earnings report, you got to make sure you do one pretty quick because it's going to be pretty important going to interview. So you know how often do firms report earnings? Once a quarter, all right? And there's three numbers. There's actual, there's consensus, and there's expected. All right, the expected is what the market expects. The reported is what the gap says, and the consensus is, or comparable, is what the market's actually focused on. So they may report $4, comparable is $4.20. Why? Because there's 20 cents in there and that's noise that doesn't really belong. So we're going to talk about that. How important is it? Can you see where Advanced Auto Parts reported earnings? Did that show up in that chart? Kind of obvious, isn't it? Was it a good report or a bad report? Pretty horrible report. I'd love to do Advanced Auto Parts, but that was several months ago, so I can't. So I'm looking for firms like that. So I want a big surprise and a big stock market. I don't want a firm that expected $2, they reported $2, and their stock went up 0.1%. That's just too boring. I want big stuff. right? So that's what I'm looking for. If there's stocks you want me to include, I can, but they have to report earnings in the next few weeks. So I can't have a firm that reported earnings 2 months ago. That's just too old data. So we need in the next few weeks. And then what I'm going to do is I'm going to pull most of the data for you. But I encourage you, you could do it yourself. So I have a YouTube video that shows you how you can use Bloomberg. Bloomberg is absolutely wonderful. You can go on Bloomberg with a company and bring up their graph of their stock price, and then you can do key events. And then you can edit the key events to bring in earnings, and it brings up all the earnings announcements. You can see what happened, how the stock, so you can see a big E right there at the top of that, and it'd be an E in red because it was a bad report. You can click on that E and it brings up all their earnings historically. What was expected, what they actually got. You can do revenues, you can do margins. So I'm going to bring all that in for you. So I'm going to give you a lot of data. You just have to write the report. But it'd be great if you could do that yourself. And that's a really powerful thing to do. And you can dive even deeper on that because Bloomberg will even kick you to the firm's conference call. You can listen to the conference call if you want to. It kicks you the reports that the sell side has written. You can read those. So Bloomberg links you to all kinds of stuff. So you can get everything you need. So paper 2 is one that you could go into the Bloomberg lab and do the entire paper in a few hours, just sitting there in front of Bloomberg. Everything you need is sitting there.
So this is some papers in 30th, what happens
Well, it's through Friday.
See you tomorrow.
Well, did I say the 30th? Okay, well, it's the 30th, fine. I'll edit it. But the 30th is pretty. If you have it, turn it in tomorrow because I don't know why I would have said the 30th. What is the 30th? Saturday? Yeah, if you have it, turn it in tomorrow. Well, if I say Saturday, it won't be midnight on Saturdays, so it might be like noon on Saturday. If I don't get enough tomorrow, there's a chance I won't get them all graded by Tuesdays. So, so if you have it, don't hold up. I'll edit it, but yeah. Sorry, I can't remember. I usually have things to do on Friday, but all right. So I'm looking for some firms. We'll see. There is an earnings season. So on earnings season, you'll see articles on a company that's reporting earnings. And we'll get into that next week. I'll show you the earnings calendar. And I actually like NASDAQ's earnings calendar is better than Yahoo Finance's. But they're all different. I wish they would all have the same information. But I'm looking for exciting stories. To me, the most exciting is a firm that beats and their stock price falls 10%. That to me is the most interesting. Now, how often does that happen? So what would you expect? A firm was expecting $2, they report 210. What do you think the stock's going to do? Should go up. Are they expecting $2? They reported $1.80. What percentage of the time is that true? When they beat, the stock goes up. They miss, the stock goes down. It's hard to believe, but it's only about 60% of the time. 40% of the time, it goes the opposite direction. They beat and the stock actually falls, or they miss and the stock actually goes up. Why is that? Because there's a lot of information in there. If you look back at Advanced Auto Parts, yeah, they missed, but they didn't miss by as much as that stock fell. But they also have revenue, where they hit on revenue. You also have margins. You also have what management is saying. And so there's a lot of things going on. So those are to me that are most interesting. Well, they beat, but their stock's down 10%. There better be a story for that. There's going to be someone that's going to say something. That's when you really want to get into the earnings call and see what are they saying. So it could be Netflix saying, yeah, we beat, but our new subscribers this month, it was just a lot lower than what we were expecting. We thought this new, we raised our fee or whatever, and we thought it was going to work, and we're seeing a lot of people shut down their account, whatever. You get new information because the earnings might be 3 or 4 weeks old. Just new information this month can be really, really big. So, all right. So we'll get into that paper more next week after you get paper 1 done. All right. Let's look at some tactical. So here's an example. We need to position our portfolio for, this is a few years ago. So this is a COVID. Obviously, in 2020, everybody's talking about COVID. I believe the economic fallout from COVID will be much worse than expected. So obviously, they got that wrong. Many are assuming there will be a rapid recovery in late summer or early fall, but I believe the economic downturn will be much deeper and last much longer. Got that really wrong. Corporate earnings will fall and stay down for 4 or more quarters. This was kind of the pent up demand scenario people were talking about. So we're going to get a vaccine. The vaccine's going to be perfect. So that didn't quite work out like we thought it was going to be, but everybody's going to get a vaccine. COVID will go away. We'll never have to worry about it again. And then people are going to go out and start buying all this stuff because they got all this. They got the stimulus checks. They can't spend it on anything. Suddenly they're going out and spending all this money. So all of that was wrong, but so is this. So both sides were wrong. So why didn't people go out and spend everywhere? Because they had this massive supply chain mess. There was nothing to buy. They still didn't want to go to theaters. So it was like this thing, I got all this money to spend, but there's no place to spend it. Just so many bread makers you can buy, right? So it's just kind of like we ran out of stuff to do. But here, this scenario is a little too negative, but that's okay. We're gonna have to go with it. Consumers will be wary of spending. Europe and Japan will probably do better than the US. So that tells you the developed markets already. What do you think? Within stocks, you're going to overweight developed, underweight the US. So that's an obvious one. Their economies should come out stronger. The US dollar will weaken. That gives you a second reason for developed markets. Rates will stay very low and show little volatility. All right. They didn't say rates will fall. They say they'll stay low. Right. So that's kind of interesting because we had a pretty steep yield curve back then. So if rates are low, where they're going to stay stable, short-term rates are making like 0. You can make like 1 or 2% going out. So you can get a lot going out, even though it's not all that high, but you're picking up a lot. If they're going to stay stable, you might as well get that 2%. Developing emerging countries will fare the worst. Let's see, developing. Don't get developing and developed. So developing will fare the worst. So the healthcare system will be inadequate. Spreads on corporate bonds, municipal bonds should widen dramatically. But triple Bs are going to widen a whole lot more than triple As. So again, you want high quality here. Corporate balance sheets are highly leveraged, and issuing debt, municipals are facing huge. So it's kind of all this debt firms took on to buy their stock back. They're going to regret that because now they're going to be wishing they didn't have all that debt. So when you look at it, these are the decisions you got to make. Look at the scenario. Weak economy, weak earnings. So obviously you're going to avoid stocks. You're going to go up to high quality in this case. You're going to like developed markets. Emerging markets are the worst, a weak dollar. So you're going to prefer developed markets. Falling interest rates. I say falling interest rates. They don't really say, well, let's see. Here it is. Interest rates in the US will continue to fall. And then once they fall, they'll stay low. So that especially you want to go out on duration. Right? If they're higher now and you expect them to fall and stay down, you might as well lock in some better rates now. Widening spreads, especially munis. I don't know why I say especially munis. Nothing on inflation here at all, but does this sound like an inflationary environment? Doesn't sound like much inflationary pressure, right? The consumers aren't spending, the economy's weak. And corporate balance sheets, let's see, nothing on alternatives at all, but you could probably guess on alternatives. You said the dollar is going to be weak. What does that kind of suggest? It'd be a good place for gold. Might make some sense. All right, so you put that in there. What would you do on long-term treasury bonds? First of all, how many bullets under that one? Always will be how many bullets? Always 2, because long-term treasury bonds are 2 things. They're long-term and they're high quality. Long-term has to do with the direction of rates. High quality has to do with recession or not. Do you want long-term in this environment? She said rates are going to fall and stay down. So, right, you want long-term, lock in the higher rates. So, yes, overweight. What about quality? You want quality in this environment? Yeah, you definitely want quality in this environment. Intermediate term inflation linked. Probably no reason to allocate to those. I would probably just avoid those. All right, mortgage backed. This one's pretty interesting, right? Mortgage backed. What does she say about volatility of interest rates? They're going to stay in a pretty level. So some people argued they're going to fall and then stay level, but I don't know if I want mortgages if interest rates are going to fall. So I might avoid mortgages until rates fall and then get them because the rates are more stable, but that one's a little tricky. So I could go, there's several different arguments. Usually mortgage backs is the one where you can, it's a little tricky what you do. If you want to say, hey, I want to overweight mortgage back because rates going to be stable, I could buy that argument. Most people would be worried about rates falling and people refinancing. What about medium quality? That's probably a little too low quality. You probably want to move up a little higher than that. If you're triple B, you probably want to move up to single A or so. And then you can do the math between the municipals and the corporate bonds. You take the 275 and divide it by 1 minus the marginal rate. What about high yield junk bonds? Avoid those. So I have a lot of students that get to that part and they're like, I don't know what those are. Those are the lowest quality bonds you can have. That's the lowest quality of all. So if you're expecting a recession, you want to flee from those at all costs. Those are going to blow up and be terrible. What about duration and rates falling? We don't care about that with high yield. High yield is not a duration play. You just want to get your next cash flow. You know, you say, oh, they got a duration of 5 years. No, they don't, because there's a good chance they're not going to make it that far. If you're high yield, they may go out of business in 2 years. So you're just if they survive, you're going to make money. So duration is not an issue there. Well, we got low beta and value stocks. We got large cap and small cap. So there's 4 things right here. So between large cap and small cap, what do you prefer? Large cap. And what are those 2 words you put there first? In stocks, have a preference for large cap, avoid small cap. What about low beta? Does that sound good? You want low beta or high beta? Low beta, you want those defensive stocks. What about value stocks? They're low quality, you're expecting recession, you want to avoid those. So you see there's 4 things, you can have 4 bullets. Everybody understand that? I know everybody doesn't because it never works in this exam, but I'm hoping this will be the first class where everybody gets it. There's 4 things. They're large cap versus small cap. That's 1, 2. So you want large cap within stocks, avoid small cap. And the low beta is good because of recession. You have to say that, right? You can't just say, I want low beta. You have to say, I want low beta because we're expecting a recession. I want to avoid value because we're expecting a recession. Put all that in there. So there's 4 things there. What if you say one of them? You get 25% credit on those. So developed market, how many things there? 2 things there. So she's expecting Europe to do well. So what does that say for developed markets? Overweight. And what's the other thing she said? She expects a weak dollar. What does that say for developed markets? Weak dollar essentially implies what? Strong euro, strong pound. So you would want it. So you have 2 reasons to overweight developed. Emerging, what does she say there? She just gave it to you, right? They're going to be the worst. If someone says this is going to be the worst, how much do you want to invest in that? Not too difficult, is it? So avoid emerging. You have to say anything about currencies there? I don't usually think that much about currencies with emerging. Emerging countries have these strange relationships with the U.S. dollar. What is Argentina talking about right now? Y'all seeing their new presidential candidate? What's he saying? He wants to do what? Makes the dollar their official currency. That's kind of wild, isn't it? Yeah. They're kind of questioning if that's even possible, but yeah, that's interesting.
A lot of countries are de facto currency already.
Well, a lot of them are kind of pegged to the dollar, yeah, especially emerging countries, because especially the commodity driven, because there's a strong relationship between oil prices and the dollar. And so, oil rich countries, they have somewhat of an incentive. All right, and then alternatives, we talked about gold. Was there anything else on alternatives? You could probably make some stuff up. But alternative, gold is probably the most obvious one. She didn't give you much else to really work with that. You bring something else in, yeah, maybe I'll look at it and consider it. And it doesn't sound like a great environment for commodities, doesn't sound like a great environment for real estate, just because those tend to like stronger economies. But yeah, you can maybe make some argument. All right, so how many things do you have? 2 things here. 1, 2, 3, 4, 5, 6, 7. Medium quality. Oh, I forgot to talk about the intermediate term, medium quality, intermediate term, and then you got the municipals versus the corporates. That's where students lose a lot of points. 3 things there. The medium quality, we probably prefer a little bit higher quality. Intermediate term is probably okay, but we kind of want a longer duration. And then you have to do the municipals versus the corporates. All right, so 3 things there. High yield, just 1 thing there. You don't have to talk about duration or interest rates there. You just want to talk about quality. Then you have to do stocks versus bonds overall. That's not on the list. Remember, that was not on the list. Here you want to overweight bonds, underweight stocks. So there's another one. There's two things here, two things there, two things there, one thing, and then who knows? So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16. So there's always 16 and then alternatives. Who here can name all 16 without looking up there? I'm going to give you some high quality bonds. You got quality and duration, so you got to talk about that. Inflation's pretty obvious. Mortgage backs, you can talk about convexity there. You know, that's the kind of thing. Once you get past mortgages, well, the intermediate term here, most of this list is going to be related to economics, whether you expect a recession or not. So the bonds that's really tied with are interest rates rising or falling, or going to be more volatile or less volatile. Questions on that?
For this, like an example of question 2 on the exam. So we'll go like a passage where what they expect for the economy to do. And
yeah, I'll show you an actual exam. Here's an exam. Here's 2 of the previous exams. And guess what your team case would be after alternatives. You're going to do one of these. So I got to find one. I shouldn't be showing you all these because I don't have to write a new one just for the team. So I'll have to find, maybe I'll find one from like 10 years ago and see what I said. But, right. So I give you the scenario and then I give you the asset classes, except for stocks versus bonds. I'll leave that out because that's an obvious. In fact, I usually would start with that. That's like, to me, the most important thing. Yeah, we're going to underweight stocks. So I'd start with that. Now, it's what some students do. You only have 30 minutes, so you got to move fast. But you're looking for those key things: direction of rates, volatility of rates, anything on inflation, recession or not a recession, the US dollar. You're looking for those kind of things. So what some students do is they bring a highlighter in so they can mark stuff up. I believe markets are pricing a hard landing, Federal rate to go too far. However, I'm much more positive. So what some students do is they highlight the wrong things. You don't want to highlight that. Are they expecting a hard landing? No, the exact opposite. All right. So be real careful. Make sure you read it carefully. So positive on the economy, seeing much more upside than downside. The first major drop in headline inflation will buoy markets. She's not saying inflation is going to drop. She's saying the first, and this actually came true. If you look back earlier this year, we had a mark on inflation that was very positive. The markets just crazy. So they got that one right. Any resolution of Russia-Ukraine conflict, we haven't really gotten that yet, which I think will occur. So they're wrong on that one. Should result in immediate relief, energy and food price inflation. So somewhat saying that she's expecting Ukraine and Russia to resolve, and once that happens, oil prices will probably drive down. Now, the problem with that is we're already seeing Saudi and some others pulling back on supply to keep oil prices high. So there's other factors going on there, but and throughout the world, corporate earnings will rebound. Corporate spreads will narrow. The U.S. economy will do well. But Europe and Japan more strongly. What are you thinking on developed markets versus U.S.? Which do you prefer here? Pretty strong argument for developed, as they struggle more because they're getting hurt more by Russia. The U.S. dollar will weaken. Yeah, you're getting some gold argument there. Coming off its recent sharp rise, interest rates in the U.S. will fall back. Wow, pretty aggressive, back below 3%. That's a pretty, now who knows what rates were when I wrote this. But that would be a pretty strong upward push for bonds. This decline will be quick, but then rates will settle down into a tight range. So volatility is going to be low, which is the same issue we had with the last one. You know, it gives you kind of a conundrum for mortgage backs. I think in this case, mortgage backs is a tough one.
So you might say, yeah, with rates fall, people may refinance. My guess is everybody's going to refinance did back in 2018, 2019, 2020. If they didn't then, it's like, maybe they took out a loan in 2022 and that's not that many people. There's maybe some, but there is this kind of refinancing fatigue. Everybody's done it. The people who haven't probably just can't afford to. So interest rate be much less volatile than expected. Emerging countries will bounce back very strongly. Even given a renewed trade, U.S. and other countries' inflations will start coming in much lower than expected. Commodity prices will show some weakness, so there's an alternative. They're artificially inflated by supply chain. Commercial real estate should hope well as mortgages falls back down. So she gave you a couple of things there on alternatives. I believe there are some supply-demand imbalances in commercial real estate that could push real estate valuations higher. Sometimes she just gives you the answer. So that's pretty obvious there. So what I'm looking for there, that that real estate's an alternative and to bring it into that part of the discussion. Because look what she gives you, or what I give you. I don't give you gold and real estate. I'll just say alternatives. So the only key there is what falls under alternatives and you put that into that discussion. Our marginal tax rate is 30%. All right, so before you even start, rates are going to fall. So what do you think on duration? Extend out. So it's just kind of unusual circumstance where interest rates are going to fall and the economy is going to be strong. When does that happen? When inflation comes down. So she's got kind of the 80s type of scenario going on here. So normally that's not the case. Strong economy expect rates to rise, but here, because the economy is bouncing back as inflation's under control, she's expecting both. This is like the best world possible. Interest rates falling and a strong economy. So do we need high quality treasuries? So here's how I would write it. Well, let's start off with what? Stocks versus bonds. What would you say there? Overweight stocks and underweight bonds, especially high quality as expected, strong economic rebound. All right, that's the kind of thing you write. That's why it's only 30 minutes. You don't have to write a paper. You just got to say what you want, overweight or underweight, and why. I'll highlight your answers. Short-term bonds, underweight, short-term, why? Expect rates to fall. Now, I have some students say underweight the short term because I'm expecting a strong economy. That doesn't make sense. Right? Why are you underweighting short term? Because of interest rates, not because of the economy. Okay. So make it really, really clear. Underweight the short term, underweight treasuries, as do not need high quality and strong economy. All right. What percentage credit would you get for that so far? That's 100%. I'm not giving you a bad answer. I'm giving you a good answer. Okay, and it's not that many words. Questions up to there? Y'all see why I say there's 16 bullets? Y'all see what I'm talking about here? All right. Intermediate, what do you say here? Intermediate inflation. Underweight. Because why? Yeah, not expecting inflation to fall. She got that right. Inflation has come down. Oil prices haven't come down. She's got that wrong.
Who is she?
Your boss.
Okay.
Your boss is saying this is what I believe, and you're going to convert it into a strategy. Mortgage backs is a tough one. So the obvious thing is to take the convexity side, and rates are going to fall, but they're going to be really stable. So you could certainly say overweight as expect
rates to be stable once they fall to new levels, though might have some concern about refinancing. But here's the key, you got to say want to capture a higher starting yield, stable rate. So MBS is maybe the hardest one there. You must say, wow, I don't understand that. So you leave that blank. So you get 17 out of 18. That's a pretty good score. So you can completely miss this one and do all right. This isn't where students get crushed. They get crushed mainly on the stocks because there's 4 under the stocks, and then get crushed on the municipals. And so that one, there's more than one answer there. I've seen, there's one student, boy, I should go find his answer. He gave a really astute answer. It was really, he put a whole paragraph in there on that one. It was a really, really good answer. All right. On this one, you've got 3 bullets, but you can combine them on a municipal. So you got low to medium quality. What would you say to that part? You like low to medium quality? Overweight, as expected, strong economy. What about intermediate? Okay, as rates expected to fall. So can go longer term. Now, that's the kind of thing you want to say, well, maybe I want long term. Well, intermediate term's not bad. Most people are intermediate term. That's pretty normal. Most people aren't short term or long term. Most people are intermediate. In fact, most bond investors, that strategy versus tactical, if their target duration is probably the Maryland's aggregate, which might be, say, 5-year duration, well, now it's probably more like 4-year. Their actual policy can say they can only vary by 0.25 years. So if they think rates are going to fall, the most they can do is go from 4 years to 4.25 years. So they can't go any further. So they don't have much room there anyway. And then the last one is munis. There you got to do the tax adjusted yield equals 0.041 divided by 1 minus 0.3. That's 586. So roll rate, munis versus corporates as 5.86% is greater than 5.15%. Does that one make sense? That's probably where students lose most of their points. I get a lot of students who say overweight, underweight, and that gets you nothing. Even if you're right. You got overweight is the answer, you say overweight, you get 0 points. I don't even know why you want overweight, all right? That's the key here, is the understanding. Let this sink in, because some people in this room are going to really mess up on that part. And if you don't understand it now, you probably won't understand it on the day of the exam. I don't know what magical thing is going to happen, because right now we're right in the middle of it, so you're really focused. So it doesn't make sense. So which of those 3 things is it someone struggling with? Y'all got it? All right, junk bonds, how many things there? Yeah, only one thing there, very straightforward. How many things here? 2 things. So large cap. What's those 2 words you need to say? Within stocks, preference for small cap over large cap given strong economy. And the other one, low beta. So here I have to say I kind of said overweight, so underweight. Yeah, this one I mean, I'll give you full credit if you said within stocks, underweight, large cap, low beta, within stocks, underweight, low beta, prefer high beta, strong. Here's where students really mess up. They'll say overweight, large cap, underweight, large cap, low beta as expect, strong economy. Well, that looks right. The problem is, I don't know if you want me to underweight them because they're large cap, or do you want me to underweight them because they're low beta? How do I know which you mean? You see a solution? The way I did it, right? So here it's correct, but you might be saying, hey, they're low beta, so underweight. But it's also the large cap. So the only way to fix that is to make sure you have two bullets and you hit each of those separately. Really, really important. Now, if you said this here, see, I say small cap and mid cap. If you say this here, I'll give you full credit for the mid cap because you said you have a preference for small cap, mid cap over large cap. So you said it, so you don't have to say it twice. But if I were you, I'd still be safe. So mid cap, overweight, as expect, strong economy. And then value stocks, overweight, expect, strong economy. Again, if you say overweight mid-cap value stocks because expect strong economy, I'll give you 1 point out of 2. Because again, I don't know why you want me to overweight. Okay, so you got to see there's 2 things there. It's not 1 thing. And I know I'm saying that over and over again, and yet there are a bunch of people in this room and I'm not going to get that. It always happens every semester. There's 4 out of 16, so there's 25% of the grade right there. So that's pretty important. Between that and municipals, you're almost up to half the exam, half the grade. So make sure you got those down. Questions on that? Okay, developed market, how many things here? So overweight versus US as expected to rebound more strongly. Overweight versus US as expect what? Weak US dollar. So here you're going to talk about their economies. Europe and Japan will rebound more strongly. The dollar will weaken. So that's where you talk about currencies is underdeveloped markets, not under emerging markets.
So that will always have like
Yeah, I keep them consistent. So you're not going to have something where Europe's doing really well, but the dollar's strengthening. Because it just, even though that can happen quite frequently, right? Because a weak dollar is great for our economy. It makes our exports really weak. So currencies are a pain, but I'll make it simple. And this is certainly possible just because the dollar has been so strong. So it's possible the dollar will weaken just not because our economies is not doing well. It could just be because the dollar has just been so stretched. And it's rebounded here lately, hasn't it? It's just crazy what the dollar is doing. Probably because our interest rates are going up so much. So, all right, emerging, overweight, as expect, especially strong economic rebound. I forget how they put it. You could almost quote them. Will bounce back very strongly. So add an extra word in there. And then alternatives, you definitely going to overweight commercial real estate.
Here, you're just gonna essentially just quote whatever they said. Commercial real estate should hold well as mortgage rates fall. She add some more, so you could add more of that. The other one that's kind of obvious is overweight gold with $8. And this one's real straightforward. So here we have 18 things. And if you get 9 of them, what's your score? 0.5. It's real straightforward. It's easy for me to grade. And it should be easy to really get. I actually think everybody should get at least 70, 80% on this because I mean, a lot of them are pretty obvious. And then I have a lot of students that get like 5%, 10% credit. And it's pretty amazing. A lot of students just say overweight, underweight. So this is like this rent and this not, I don't even think, just hoping 50-50 chance they'll get it. But that really bothers me because to me, it's not so much they're going to be better than an exam, but it's like, what did you get out of the class? Because that's what we've been talking about for like a month now. So it's really important stuff.
You want to answer exactly like that.
Yeah. Well, you won't, what most students do, you have to do it by hand, you're writing. What most students do is like for emerging market stocks, they might write EM stocks, just same time writing, and then they'll do the bullet underneath. But yeah, they'll rewrite the titles and they'll put the bullets underneath. I guess I could help you out by kind of having a print out on the back that has all of them listed. I don't know. We'll see. But yeah, you've got 30 minutes. It usually doesn't take 30 minutes, so most students can do it without any trouble. I mean, before COVID, you won't believe this, but before COVID, we did question 1 and question 2 in class in 75 minutes. By hand, writing by hand. I could even show you some links, and that's pretty amazing, right? I still have Rebecca's exam from them. It was amazing. I don't know how she wrote so fast, but y'all can't write anymore. Your hands will claw up. It's just you're out of shape. You can type a million words a minute, but yeah, we're just not good at writing anymore. So I just can't have you write for 75 minutes. I can't do it anymore. It's just, I took the CFA exam. It was 6 hours of writing, and I actually bought those sewing thumb things and put it on my thumb because my thumb, and at the end of the exam, my thumb was numb for like a month. I had no feeling in my thumb. So y'all just can't write anymore. It's just really tough to do. But on this one, it's only 30 minutes. You can write that much in 30 minutes. It doesn't take that much.
So it's 30 minutes for this section. Is there any other section, or is that everything?
That's the entire exam, but once we finish it, we'll have class. So we'll stop after 30 minutes and we'll have our normal class. So yeah, it's capable to do if you understand it. And again, you ask the question, what is on this? That's not part of question 1. And it's all the same stuff. There's nothing in here you weren't learning for question 1. So this is just the application part of it. Most students do a lot better on question 1 and question 2. Occasionally I have a student ace question 2 and mess up question 1. A lot of people do well on both. Some do horribly on both. Some are kind of mediocre on both. But occasionally I have an extreme where aces 1 and crashes on the second one.
And what's the weight between the 2 questions?
It's 2/3 question 1, 1/3 question 2. Yeah, it's 2/3, 1/3. It's 50 minutes, 25 minutes, the way I was saying. I do like to see the CFA exam is in minutes. This is a 30-minute question. This is an hour-long question, so I do it like that. Right. I'm not going to show you the second question because I'll probably use that as the team exercise. And it looks similar to this, but it may be positive or negative. All right. My goal is that you understand this. So this is the way you gotta start thinking. So when you start hearing things, you automatically start thinking of strategy. And that's what you'll notice. Well, I wish I had videos of our USA asset group talking. Oh man, we were yelling and screaming at each other. There were a lot of calling security. But it's just, you got to get it right. You got billions of dollars. You're going to move around. You better fight it out, and who's going to be right. And you have different opinions. That's why you had Barney and Matt in that group, because they're always opposing forces. And then I'm out where they're just, I like to throw like red herrings in, just throw the whole group off. We'd invite guests. In fact, we had interns, and I was kind of radical in interns. I was like, you're an intern? No, you're coming to our asset group. And you can speak all you want to. I got a meeting with the CEO. You want to go along? I mean, I was like, my intern's like, oh yeah, sure, I'll do that. So we had we had an intern still in college, and they're debating stocks versus bonds, and the group was open to it. Anybody had an idea, come in and bring your ideas. But the thing is, it's time. You know, someone says, what's the Fed doing? We all exactly know what we're starting to think about stocks versus bonds by hearing that conversation. We don't have to sit down and say, well, when the Fed does this, this happens. We all know that. It's just kind of second nature. It's funny, the guys and gals from Victory Capital USA, they invited me to a dinner party. So I show up and it's all of them and their spouses, and it's men and women spouses, men and women portfolio managers. After about 20 minutes, all the spouses are in the kitchen talking whatever, and all of us are in the living room talking markets. And the spouse is like, don't y'all do that all day long? Yeah, we're going to keep doing it all night long. That's all we talked about. That's all we cared about. So you have to have that kind of passion, because this is really tense, stressful stuff. If you don't have that kind of passion, you're going to have a tough career on the investment side. All right. Any final questions on that? So you're going to write how many bullets? At least 16, probably 17 or 18 alternatives. Okay. You're going to separate things out. Short-term treasuries, low to medium quality, intermediate term, municipals and corporates. There's 3 things there. Large cap, low beta, mid cap, value. I could do, what else is there? I guess, yeah, beta versus, sometimes low beta, I talk about those being defensive. So defensive, low beta, cyclical, high beta. So you have to know that term. Developed markets, always 2. So if you have that down, it should be a piece of cake, right? So what are y'all going to make on question 2? What do you predict for your class? Higher than last semester or lower?
Last semester.
Average or median? I've had classes, the median's higher, but the average is lower. Why is that? So when the median's higher than the average, what's the problem?
People weren't.
Yeah, you have a few people that are really bombed, but the class and average is better. So we'll see. So your goal is that the median and your average is higher than the previous class. That's what we want to do. Okay. All right. So where do we go from here? So next week we'll have a team question on Tuesday, not on Thursday. So Thursday's the UTSA day, and we'll probably have to end class a little early. I was thinking about I leave at 3:30 and you do your team question and then just email it to me, but probably won't do that. So USA is here on Thursday. So we'll have the team question on alternatives on Tuesday. And then the week after that, I forget when is the exam? 17th. So we have an extra weekend. So I have a team question on the tactical side. I give you that question. So where we go from here, we still have some time. Don't leave yet. We still got some minutes here. We're going to get into the execution side. And here, what we're going to do is get into quite a few things. So we got to talk about just this idea of mutual funds, ETFs, commingled funds, separate accounts, all those different type of things. I want to talk some about how you pick those. How do you pick a mutual fund? Get into that. We're going to have to talk about fees for investing, passive versus active. We got a lot of things going on in here. How you trade, those type of issues. So it's a hodgepodge of things. There's not much math in this section, so it's a lot of discussion. The key here is that you feel comfortable going out and investing. So we just said, hey, I want to buy large cap growth stocks. So how could you do that? You could buy a large cap exchange traded fund. You could buy a large cap growth mutual fund. You probably can't do a separate account or a commingled account. We'll talk about what those are. So we got to get into that kind of detail. If you don't have a brokerage account, I really encourage you to get one. That's where the ETFs come in. How many of y'all have a mutual fund? Anybody mutual fund? How many of y'all ETFs in here? Buy ETFs? So how many of y'all have a brokerage account? A few of you. Y'all buy individual stocks then that don't have ETFs. So we'll talk through that. I might bring my Schwab account up. Maybe I'll bring my mom's Schwab account up. And we'll do some trades. I did some trades for her earlier this week, but we'll do some trades. So, and if it doesn't work out, I'll blame y'all. All right. Well, I guess I will stop a little early. I don't want to start in the middle of that. So.